So, you guys have probably heard a whole lot about the fundamentals here from various presentations, various speakers, and a lot of it, I would guess, probably focuses on things like news events, things like correlations, but I would venture that very little of it is probably focused on understanding the big picture and shaping a sort of world view as to why in certain environments currencies rise and currencies fall, and really what makes for major long-term trends in currencies. And so what we're going to talk about here, and this will be review for some of you that have been in some of my sessions, is first of all why currencies rise and fall in the larger sense, why we look at things like economic data and why we look at things that shape the economy and shape monetary policy, and what that means for shaping a bias on a given currency, and what that means for essentially deciding if you want to be a buyer or seller of something in the broad sense, and sort of filtering your decisions from there. So this should be fairly familiar at this point. The major forces that have been driving currencies over the past several years have been the outlook on rates and risk sentiment. And the outlook on rates is sort of a very classic type of interpretation of why currencies rise and fall, because the interest rate set by the central bank is essentially the de facto sort of benchmark return on holding a currency. And the simple example that I like to use is essentially sort of imagine you have 10,000 euros, right? And imagine somebody wants to borrow those euros. How much interest would you charge them? The central bank has a sort of benchmark lending rate that they will lend their country's or their region's currency. And they are sort of a lender of last resort. If you can't borrow anywhere, you'd borrow from the central bank, sort of immediately responsible for those currencies. And so it would make sense that you would not charge an interest rate lower than that central bank. That is sort of a minimum. And so then the owning of that currency carries with it a de facto rate of return. That is that interest rate. And so the reason we as traders care about this, obviously, is if the central bank were to raise the interest rate, the return on owning that currency rises, which would make it more attractive and which would bring people to want to buy it and which would raise the price. And obviously vice versa, right? If the central bank were to cut the interest rate, the de facto return on owning that currency declines. And so it becomes less attractive, and so people sell it in favor of other currencies where the situation is in reverse. And very critically, what we care about, and this has already come up several times here at the Expo, and I get this question constantly, what we care about is not where rates are, but where are rates going? Where do markets expect rates to go? And how do those expectations line up with the reality of where rates go? Because where they are at any given moment in time is already reflected in the market. It's reflected in the price. It's what the newswires and your CNBCs and Bloombergs of the world call priced in. So what the markets care about is not what's there at the moment. That's already there. What they care about is how does reality line up with where they expect things to go? And if there is a misalignment there, if reality turns out not to reflect what people expect, that's what moves currencies, right? Because people have to readjust based on what they thought was going to happen to what is actually going on. Now, risk sentiment. This is a little bit more nuanced, and I'm sure you guys have heard the terms risk appetite, risk aversion, risk on, risk off. I'm sure you've heard this tossed around a lot. And basically what this means is it just reflects investors' willingness to take on market risk. And so basically, if we really sort of strip this down to its essence, what this tells us is, what do investors believe the world looks like, big picture? Is the picture positive? Is the picture negative? Do we expect growth to accelerate or decelerate? Be positive or negative on a global scale, right? Because if growth is overall positive, your objective as an investor is what? To find the place where assets are rising most in an overall positive environment, and buy that asset. Our job as an investor in that environment is to maximize returns. But what if the overall global economy is not growing and assets are falling across the board, as we obviously saw in 2008? The objective of the investor becomes inherently different. Now your job is not to maximize returns because you're not in an overall environment where things are rising. Now your job is to preserve capital so that you can wait out whatever turmoil and then reinvest when things calm down. And so in looking at people's willingness to take on market risk, what we're really looking at is what environment are we in? What are things likely to respond to? A desire for returns, a desire for yield, or a desire for safety? Because those are inherently different market environments, and asset classes, including currencies, of course, will behave very differently. People seek different things. Their objective is inherently different. So what are currencies that tend to positively respond? What are currencies that tend to be sought out when people are relatively confident? Sort of risk-on or risky currencies. Those that yield the most, right? Because people's objective is returns. So they tend to want to buy things that yield more, things that are positively linked to an overall supportive global growth environment. So the currencies of commodity exporters, because commodities tend to strengthen in an environment of rising demand, in an environment that is generally positive, right? That's good for economic growth in those countries, ultimately good for the overall level of output, which invariably is overall good for monetary policy, because with economic growth comes inflation, with inflation come rising rates. And so in those environments, you tend to see the currencies that are higher yielding do better. And currencies that are linked to global growth because their economies are sensitive to global growth, call it the overall global business cycle, those do better. And you can see that here. That blue line is the Aussie dollar. That red line is the S&P 500. Now, why the S&P 500? Because at its core, what is the S&P 500? It is a reflection, real time, of investors' expectations of the earnings of the world's biggest multinationals, biggest companies. What is that a factor of ultimately? Global growth. And so the S&P essentially gives us a real-time gauge on investors' expectations of which world they are in. A growth positive world where earnings rise, or a growth negative world where they don't. And so as you look at this relationship, you say, okay, the Aussie dollar essentially reflects that same theme. It tends to rise when the outlook is positive. It tends to fall when that outlook and when that sentiment is negative. Same thing with the New Zealand dollar. Same thing with the Canadian dollar. And one note here, that's dollar CAD upside down, right? Because what we want is the relationship between Canadian dollar and the S&P. So strictly speaking, that blue line there is CAD dollar. Now, what are safe haven currencies? Currencies that do well when people are not generally optimistic, when what they're looking for is safety and not returns. One critical quality, obviously, is liquidity. Because when you invest in something because you are afraid of everything else, one critical component is you want to be able to get out quickly so that when things improve, you can reinvest, and you want to be able to move in and out with fairly easy characteristics. So you don't move the market if you get in and out in mass. And so liquidity becomes very important. And of course, store of value. This, by the way, is a major argument for gold as a safe haven under some circumstances, right? Because if you're afraid of the overall environment and you are looking for safety, a critical component is your safe haven has to protect your capital as much as possible. So it has to retain its value as much as possible, which invariably brings us to currencies in countries with deflation, where prices are falling in terms of the currency. So Japan, Switzerland. And when we're talking about liquidity, that invariably brings us to the US dollar, which is by far the most liquid currency, head and shoulders above everything else. And so when people are afraid, they tend to flock towards those currencies, although they yield effectively zero, most of them. At this point, all of them. Because the objective is not to earn a return, but to park your money and keep it safe, at least more so than otherwise. And so here is a chart of our yen index, sort of the average value of the yen against most of its major counterparts. And you can see that it moves very closely inverse of the S&P. So as the S&P goes up, the yen declines, and as the S&P goes down, the yen rises. By the way, that chart there going all the way back to 2007, so you can actually see the response of the yen during the 2008 crisis. Similarly, the US dollar. That's an average index of the US dollar. And again, you see a very strong relationship. Now, it's not as clean because there are several episodes there recently where we see the European financial crisis and debt crisis get in the way, and obviously it's somewhat skewed by Fed's quantitative easing. But still, it's a very compelling inverse relationship that tends to hold more so than not. So how do you build a world view around that, knowing that's the dynamic that tends to guide currencies? Well, we've been talking a lot about global growth, so the natural question is, where does global growth come from? And if that's the overall global growth pie, you can see that about 3 economies there account for 51% of all global output. So what we should really be caring about is what happens in those 3 economies, because they are the engines of growth. The US being the largest at almost a quarter of global GDP, the collective Eurozone, and I take the collective Eurozone because they have a single central bank and obviously a single currency, and China. So here is a forecast for where global growth is going in 2012 and 2013. And as you can see, the world is expected to slow this year and pick back up a little next year. At least that's what people are expecting so far. So what we're going to do here is we're going to go through what this table alone, just growth, just expectations, would tell us in terms of developing a directional bias first this year and then sort of backtest it to see how that worked out, since we're almost at the end of this year, and then look forward and see how that develops into a forecast for 2013. So first, let's take a look at 2012. So notice, the world economy in 2012 forecast to slow compared to 2011. The Eurozone expected to go into recession. You can see that growth rate is negative. The US economy is expected to accelerate slightly, and China is expected to see a slowdown. And so I've color-coded our pie chart here, where the US is green because growth is accelerating, China is kind of a mild red, and the Eurozone is a bold red. And as you take a look at the currencies likely affected, you can see, sort of in the case of the Eurozone, it's obviously the euro, but to some extent also the British pound, because the UK exports a lot into the Eurozone, and so if you lose demand in the Eurozone, the UK is affected. Same logic for the US and the Canadian dollar. And in the case of China, since we can't trade the Chinese renminbi, since it's locked on shore, we trade things linked to Chinese growth, things sensitive to Chinese growth, and the natural contenders in the G10 are the Australian and the New Zealand dollar. In fact, arguably the reason Australia is as resilient as it is because for the past several years they've been digging up everything you can find in Western Australia in terms of iron ore and coal and selling it to China. And so based on that outlook, we can figure out some guiding themes, and we can, from there, as we translate this into FX, figure out a general directional bias. So we know based just on that table, we're expecting growth to be slower, we're expecting the Eurozone to be in significant pain, and we're expecting the US to relatively outperform China. I say relatively because obviously China is still growing at a rate much faster than the US. But as I said, the markets don't care about absolutes. They care about direction. They're looking forward. So the relative outperformance here is found in that the US is expected to accelerate while China is expected to decelerate. And so when we translate this into currencies, we say, okay, so overall, in this kind of environment, the safe havens should do well because the overall environment is negative. We should expect the ECB and to some extent the Bank of England to do more to try to stimulate growth in the recessionary environment. So rates should probably come down, which should be negative across the board. And the Canadian dollar, which is a currency linked to US performance, should do better relatively against currencies linked to Chinese performance. So how does this actually pan out? Or how did it pan out? So we'll take one of those themes and we'll take a look here. That's a chart of Aussie CAD. And as you can see, that yellow line is the first of the year. So utilizing no technicals, utilizing no other form of analysis, which incidentally is not something I would suggest. I would suggest utilizing technicals to time these kinds of things. But if you did none of that, and you just said on the first of the year, here's my growth forecast, I am going to, right there on the 1st of January, sell Aussie CAD. You would have seen Aussie CAD decline, as expected. Now, if you had utilized technicals and picked your levels more precisely, obviously you would have done better. But you can see that global growth expectation in action right there. Now let's look a year ahead and see if the same thing can be expected. Now we're looking at a world that is somewhat different. The US is actually expected to be slowing. The world is expected to be accelerating, although very marginally. The Eurozone is basically still anemic, but China is seeing a bit of an acceleration. And so as we look back at our pie chart and say, okay, well, how does this translate into FX? We see some different conclusions. We would expect risky currencies to do better. We would expect European growth to continue to be a hindrance because a growth rate of close to zero is not much of a growth rate. And we would expect things linked to Asian growth, Australian dollar, New Zealand dollar, to begin to outperform things linked to North American growth. In our case, as FX traders, the Canadian dollar. And so let's look back at that same theme and see how our Aussie CAD is going to potentially do next year. You will notice that through the past 12 months, it's declined to a significant support, a support that it's hit a few times. And so the question becomes, are we readying for a rally now? Now, personally, I would say the outlook on global growth is still a lot more uncertain than current expectations suggest. But if you were in my previous session here, I harped a lot on the fact that you should trade what the market gives you. And if your fundamental outlook is not lining up with what the market gives you, since it is the market that will either put money in your account or take money out of your account, it is probably a better idea to, at the very least, not trade your convictions until it appears the market is actually responding to them. Or tactically trade against your convictions with a very tight stop and things like this, which incidentally I don't do. I would rather wait.